Skylakakis. Hello, Minister. Έξι-επτά λεπτά για introduction και μετά ένα session ερωτήσεων. We can manage that. So thank you all for being with us, and thank you for your kind invitation, Daniel, and your introduction. It was just a year ago when a team of experts I was cooperating with, supervised by George Pagoulatos, we were drafting, let's say, a policy paper based on the EU regulation, and among others, it was about risk sharing. I remember that at that time, and it was just 1 year ago, the only term that could be barely accepted by all stakeholders within the EU was the euro area safe asset at that time. Needless to say that a Eurobond was out of the question for many. The pandemic erupted and an unprecedented crisis broke out, as well as the need to strengthen our economies, the need to protect the single market and take some measures. The ECB launched the PEPP program, the Commission and the ESM, I think the EU reacted quite quick in taking some measures, and after intense discussions, we have in place the RRF. It's a political decision, and it's a decision that says that the risk sharing is there. But after politics, implementation comes, and several questions arise. For example, how do we operationalize the RRF decision, the political decision? What kind of projects do we support? What kind of projects are eligible for funding? And does growth in each member state needs the same strategy and the same projects so as to boost its economy? How reforms are connected, and when do we expect the first disbursements? So I think I have submitted most of my questions, and the distinguished speakers here may provide answers and clarifications. We have the honor to have with us the country's Greece's alternate Minister of Finance, Mr. Theodoros Skylakakis, and the leader of the Greek task force for the RFF. I think via connection, we have the president of the Euro Working Group, Mr. Tuomas Saarenheimo, from Brussels, Declan Costello, the Deputy Director, General Director of DG ECFIN is with us, Francesco Drudi, the coordinator of the country coordinator for Greece at the ECB is with us, and Professor George Pagoulatos, the General Director of ELIAMEP, the leading Greek think tank, is here in Athens, also with us. After this short introduction, Minister, the floor is yours.
Well, thank you very much. I will try to take out my mask to be a bit more clear for a few minutes. It's a good coincidence that we are now talking here and not at the enhanced surveillance where we usually meet with the other people that are in this panel. Greece in the next few years faces a unique challenge. We have to recover from a recession caused by the pandemic and the blows that it gives to our economy, and at the same time cover the huge investment gap created by the 10-year Greek economic crisis and the mistakes of past policies. Our economic policy has thus to face a double challenge. We have to counter the consequences of COVID-19 in a big number of sectors. Almost half of the economy is in trouble. while the other half is doing quite well. This is interesting. And at the same time, at the public finances, where we try to have a very responsible attitude, but still it's a challenge for the public finances. And at the same time, tackle the past problems, the overtaxation and the very high non-wage cost of labor, which are basic problems for the Greek economy, plus the bureaucracy that is burdening the and suffocating businesses, and also, and this is very important, the fact that a big part of our economy still today is in the black sector. So it uses tax evasion and pension contributions evasion, black labor, to as a competitive advantage instead of innovation, instead of economies of scale and quality. So we have to, and this is done partly because of tradition or the way businesses are built, some businesses are built, but also because of over-taxation and very high pension contribution costs. So what we are trying to do, and we're trying to do it also as a way to the recovery and to reach again growth, is to change the productive model from a more introvert economy based on where a big part of it or significant part of it uses as a competitive advantage the black economy, to an extrovert economy that looks outside and tries to compete internationally. And at that transition, it's very important to lower taxes and the non-pension labor cost. This change of economic model is essentially a big part of our government program, together with the digital transformation of the public sector and the increase of the effectiveness of the public sector. And we are forced to move towards this direction a lot faster than we had initially planned, because we need to be a lot more efficient and more effective in comparison to any other past Greek government because of the circumstances. Also, this is a huge challenge because of the Recovery and Resilience Fund, the funds connected with the Next Generation EU. Now, I will not go, as I have planned, to how this fund works. I will just say that the basic difference of this fund compared to the previous or the existing European programs is that it is based on targets and milestones rather than looking into what happens in every single project in terms of paying it with the European funds. And also it has reforms as in its core and the cost of reforms. Up till now, the European programs were loosely attached to the reforms happening in the country, and the idea of paying the cost of reforms has not yet been realized essentially in European programs. This is a big change. The second big change in this program is that the time is extremely limited. We are talking about 5.5 years between the start of the program and the end, the final end, the last payment, the last milestone or target that we have to achieve. It's sometime in the middle of 2026, while the program will start at the beginning of 2021. And this is double it needs double the speed compared to other European programs. For example, for ESPA, there were 10 years, almost 10 years between the initial planning and the final payment. Now it's 5. And when you take into consideration that in Greece, compared to the planned execution of projects, we have on average 23 months that we are late in historically in the procurement process, and then another 28 months that we are late historically in the execution process. Essentially, this is these 23 and 28 months, if you add them, are the whole time of the program. So we have to essentially make a revolution in terms of how fast and how effectively we manage things here in Greece to make this program work. And this revolution to be made needs a big change in attitudes, not only within a government, or this government, or whatever the Greek people decide in the next 4 or 5 years, because we will have also in this space an election sometime, but also in the whole of the Greek society. We need a change of attitude in the public administration. They have to look to be a lot more effective, efficient, and be less bureaucratic in their mindset, and decide to take on responsibility rather than throw it to kick the can, as we say. It has to do with the judicial system that has to work a lot faster and a lot more efficiently. It has to do with the labor unions, the local communities, on how they understand that this is a unique and non-recurring opportunity. This opportunity will never in the foreseeable future be available to us. This kind of money, this kind of opportunity for reform, this kind of opportunity for digital and green transformation, for private investment, this is not going to come again. So we have to take advantage of it. And to do that, we will do everything in our everything that we can do. We will look into the processes. We will give motives, financial and other motives. We will digitalize the whole process. We will simplify it. But also, we will try, and this is important in this gathering, to mobilize as much private money as we can, because this program can only succeed if, together with the public money that we have from the RRF and the other programs, we mobilize huge amounts of private money, both to be more efficient and effective because of the working together of public and private sector, and to have a much bigger effect in GDP and unemployment and in the change of culture in the Greek economy in general. So this is a unique opportunity, it's a unique challenge, and we will succeed because we don't have the luxury of failure. Thank you.
Thank you, Minister. And let's go to Brussels via connection. I admit I have missed my trips over there. We are about, I think, to connect with Mr. Tuomas Saarenheimo. He is the president of the Eurogroup Working Group. Mr. Saarenheimo, it is very nice having you here, even via internet connection. The floor is yours, the e-floor is yours.
Thank you very much. I can see my face there. Let me adjust this. I can see my face, but can you hear my voice?
Yes, we can hear you pretty well.
Very good. So thank you very much for inviting me to participate in this event, and my deepest regrets that I can't do it from there, but instead from this far less attractive surroundings that you see in the background. But it is what it is. So a year ago, things looked fairly good. We were living the 7th year of a rather broad-based economic expansion in the euro area, and we were optimistic about this year. Now things, as it happened, came to an abrupt end with the pandemic. As it looks now, the GDP contraction this year will be approximately in the same ballpark as the one we experienced in 2009 in the context of the financial crisis. But that's pretty much where the similarities end. This time, it was the real economy that took a direct hit, whereas the financial sector has been showing remarkable resilience. And this, I would say, is testimony to the work we have done over the last 10 years, as the result of which the banking sector entered the current crisis in far stronger capital and liquidity situation than 10 years ago. And as a result, so far, banks have been part of the solution to the problem, not the problem as such. Now, the title of this session is about restoring optimism in the financial markets. Frankly, if you look around, you don't really see an acute lack of optimism in the stock markets or the bond markets or even the forex markets when it comes to the euro. As bad as the economic situation is, the markets have found reasons to be optimistic, and I would tend to agree with their assessment here for several reasons. First, the national governments acted fast to provide substantial fiscal stimulus to their economies, and the EU fiscal rules were suspended to enable this. Also, the ECB added further significant measures. Then there were the 3 safety nets that were agreed by the Eurogroup in the spring, the ones based on the EU budget, the EIB, and the ESM, all of which are now up and running. And finally, there's the historical 750 billion next generation EU package that the minister just referred to, a package that is funded by union borrowing on the markets. Honestly, back in February, I don't think anyone, and I would include myself there, could have imagined that the union could, in a span of about 3 months, agree to such an extensive package of measures. And I think this demonstration of our ability to act is what the markets have taken as a very, very positive sign. So far, so good, but clearly this is not over. COVID-19 keeps doing damage to our society and our economies every day, and it will keep doing so for still some time to come. And even when it's over, the damage will not be undone overnight, particularly in some sectors. So while there does not seem to be an immediate risk of financial instability, we will all emerge from this crisis weaker than before. And that will make the situation fragile for the years to come. And specifically, once the moratoria and other measures are over, the banking sector will likely see an increase in non-performing loans and an erosion of capital position. So the challenge we are facing is not really one about restoring optimism. It's about maintaining the present positive sentiment in face of the inevitable difficulties ahead. So how to do that? I think you all know the answer to that, and the minister just mentioned the key elements. The measures we have put in place and the tranquility in the markets will not by themselves fix our economies, but they provide some time and shelter for governments to take the measures necessary. And the governments cannot afford to waste this opportunity. We essentially need three things. We need to fix the dysfunctional structures that hold back our economies. We need a credible debt reduction strategy, and we need a better integrated financial markets. I'll say a couple of words on each of these. First, regarding the role of the next generation EU in all this. Now, the package, as I said, is historical, but it's not transformational in terms of easing national budgetary constraints. It will support national efforts, but it is not a massive instrument of fiscal expansion as such, even in the countries that stand to benefit the most, one of which is Greece. It will reduce public debt to GDP ratios only slightly. The game-changing element needs to come from elsewhere, and it's the policies that countries will be putting into place in the coming years that matter. Policies that remove bottlenecks and modernize structures. The money that we spend in the next few years must become good debt, invigorating debt. It must finance reforms and investment that raise productivity and resilience and address challenges such as green and digital transformation. And if we succeed in this, this would at the same time become our credible debt reduction strategy. We all know that debt levels will rise substantially. There's nothing we can do about it right now, and trying to consolidate at this point would clearly be counterproductive. Fiscal support need to continue for the next year or two, maybe a little longer, we will see. But since we cannot work on the debt levels directly in the short term, we have to work on our economy's capacity to serve their debts. The road to fiscal sustainability must be through growth, and the money we spend now must be put in good use. So the aim is not to maintain our economies as exact replicas of what they were before. It's not to create an army of zombie companies in our economies. The aim is to provide viable companies the means to survive the crisis, and an environment in which they can thrive and grow again when the crisis is over. And I want to say that although the Next Generation EU is a European program, the real challenge lies with the member states. We in Brussels, we in the Union, will certainly examine each other's recovery plans. We will discuss and encourage each other. We may even apply some friendly peer pressure. But in the end, the responsibility, the ownership, the implementation are ultimately with the member states. And the words of the minister just before me were quite encouraging in this respect. My final point is about financial integration. A dynamic private economy post-COVID will rely on healthy financial sector that provides access to stable funding across the euro area. I said earlier that the work we have done to fix our banking sectors has borne fruit, and it indeed has, but while the stability of the banking sector is now much stronger than a few years ago, we still have some ways to go before we can speak about a truly unified European banking that provides equal access to funding across the continent. So we must make progress with the completion of the banking union. This is a politically sensitive dossier that has been with us some time. It touches on several complex issues: common deposit insurance, cross-border integration, crisis management, and resolution and financial stability. And finding an agreement on all this will not be straightforward, but I do hope that the crisis has focused everyone's minds and will help to overcome obstacles and help everyone to conclude that the benefits of a completed banking union are clearly greater than the costs. It goes without saying that apart from the banking union, the European economy also needs integrated capital markets, so the work must go on with that as well. But I don't have time to elaborate on this, so just look forward to work on the action plan that the Commission is coming up in later this year. I stop here. Thank you very much.
Thank you very much, Mr. Saarenheimo. Please stay with us. We will have probably time for a set of questions. We stay in Brussels, and we welcome Declan Costello, the Deputy General Director at DG ECFIN. Do we have Declan? Yes, we do.
Hi, John. Can you hear me?
Yes, we can hear you. Thank you very much for being with us, and the floor is yours.
Okay, so good morning, everybody. So what I would like to focus on now in my presentation is just to outline how, from the Commission, we see the challenges going forward to operationalize the new Recovery and Resilience Facility. So the first step is actually to complete the legislative process. So we have the political agreement from leaders of July. But in order for funds to flow quickly to our member states, we need the legislative work to be completed. So we need to get the full agreement on the own resources decision and all the legislation for the MFF and the Recovery and Resilience Facility. Now here, good progress is being made under the auspices of the German presidency. Discussions are already starting with the European Parliament. So the trajectory to have the facility operational by the 1st of January is positive. But nonetheless, it's very important that we cross the line on this. Now, secondly, without even waiting for the legislative processes to be completed, we have actually started discussions and contacts with member states on the design of their recovery and resilience plans. And I mean, essentially the biggest challenge is to get the balance right. On the one hand, we need to proceed quickly to ensure that significant funds can be transferred to our member states in the course of next year and 2022 to support the economy during what will be a very difficult period. At the same time, we also need to ensure that in the recovery plans, member states focus upon the right reforms and the right investments. And obviously that can take some time to design and certainly to implement. And it's getting that balance right between getting the money out quickly, but ensuring that we have the right reforms and investments so that we build back better occurs. That's a key challenge. Now, the Minister in his intervention actually highlighted some of the key issues which are going to come up in our discussions with member states. First element is it's not simply about investments. It's actually all about combining and investments, because experience shows us that simply throwing or spending large amounts of public money in and of itself does not remove structural inefficiencies in our economies. So we need member states to come forward with plans that combine investments with reforms. The element will be actually to be sufficiently granular and detailed on what are the actual deliverables, these milestones and targets which will trigger the disbursements. Now, this is a different way of working compared to the structural funds, where member states get reimbursed for the costs they have incurred. Here, disbursements will be triggered by completing reforms, completing investments, and here we need to ensure sufficient granularity to design our programs. Now, maybe if I can turn to just how we see the situation. I mean, to begin with, I should mention, we have had some preliminary exchanges with the Greek authorities who are starting to reflect on their recovery resilience plan. I mean, obviously, we have considerable experience working with the Greek authority. We've cooperation. So I think there's quite a wide understanding on what the key reform agenda will be, and obviously quite a bit of that will be to build upon the measures we've been working to get over the past number of years. I think what's very encouraging, what we see in Greece, is the fact that we take note of what the recent report of Professor Pisarides, and I think the Commission, we would very much agree with the broad thrust of the strategy which is outlined on that report, and which the intervention of the Minister today in terms of changing the growth model to make it a more export-friendly growth model, reducing, making the tax system more friendly, moving the burden away from labor and corporates to other sources, ensuring that the business environment is much more friendly to foreign direct investment and allowing SMEs to grow into being large exporting companies. So I think I expect that I'm quite confident that we'll very, very quickly give at an agreement of broad priorities for the reforms and investment. I think the key challenge, of course, in Greece will be actually about implementation. Here, it's important because the size of the fiscal amounts here are quite large. I mean, Greece stands to benefit in alone something around 9% of GDP. So this would imply an absorption need of somewhere between 2 and 3 percentage points of GDP, annually for the next 2 or 3 years. Now that's a very, very large number when you compare it to the current annual budget of the government for public investment, and there have been delays in executing the public investment budget for time. So I think we will need to work very, very closely with the Greek authorities on the investment pipeline and to remove the bottlenecks to the use of these funds. I'll stop here. Thank you.
Thank you, Mr. Costello, and we will return with some questions. Let's go to Mr. Francesco Drudi. He is the country's coordinator for Greece at the ECB. Mr. Drudi, the floor is yours.
Okay, thanks. I hope you can hear me well.
Yes.
Is it okay?
Yes, we are okay.
Thanks. I also would like to thank for inviting me here to this conference. I have been to the conference a couple of times, so I really miss being there physically. But of course, this is the current situation. So just one remark, I will focus more on Greece with Mr. Panetta. Fabio Panetta has elaborated on the ECB policy and the implication for Greece. I will focus a bit more on Greece, even though I will touch on general issues that cut across the country of the euro area. I will also look at a bit distinguish between the short-term and long-term, the steps in public and private strategies to support confidence, which I have to say confidence to some extent return for the reason that have been explained by a number of speakers. Of course, there's still room, there's still a lot of road to make. For example, the stock market recovered overall, but for the banking sector, the recovery was still modest for the number of reasons that have been said and I will say. So let me start first of all with the short term. It's crucial during the crisis that the appropriate measure to support the funding of the economy via banks are taken, and Greece was not an exception. This was happened across the euro area. This program, this guarantee program to support lending to enterprise had been entertained across the euro area. In Greece, as I said, it was not an exception with the program which were administered with the HDB, the Hellenic Development Bank, the co-financing, and other activities like the subsidy for lending to a non-financial corporation, and direct lending was mentioned by the minister. And I have to say that this was crucial in order to support credit without putting the banks in an extremely risky position, allow me to say. And there was, I have to say that as for the euro area, we had a positive surprise in Greece as well. The credit to enterprises picked up significantly this year. It reached 6.5% annual growth in July, which is a rate of growth which was not seen, I don't know for how many years. At the beginning, at the turn of 2008, 2019, the rate of growth to enterprise was still negative in Greece. So this is playing a crucial, a crucial role in buffering the consequence of the crisis, and the government support is playing an essential role. This, of course, is less the case for the loans to household, which, of course, are less supported, and we know also the reason why it could be, which could be related to COVID. It has to be stressed that the government also had a program to support, to subsidize mortgage payment, and this was addressed also to performing borrowers. This perhaps the first time since a long time that we have this support, which is crucial to avoid the balance sheet hit just related to the crisis on the bank. Now, the short term, what is the policy problem now? The policy problem is this enough? Will some of this program need to be extended, expanded? I have to say that so far we have seen they are working well. Of course, in a few months' time, depending on the evolution of the crisis, the recovery, the government could reconsider. But I think by then the government would have acquired good experience in how to manage this program and the implications for banks. The long term, if you like, beyond the short-term support. It's important that this short-term program are gradually discontinued in order, first of all, not to overburden the balance sheet of the government, and second, to allow the banks to do their work of allocation of credit, but at the right time, as I said. In the long term, what may support confidence of financial market and the supply of credit of banks is, first of all, of course, is the recovery. That is the key factor. We are talking about things that could improve on the underlying trend, but the recovery at the global level will be a key factor. Within the policy arena, of course, there are a number of issues that need to be done. We have to, the problem of non-performing loans will affect not only Greece, but we know that the starting point of Greece is not the most favorable, as it was already stressed. So the non-performing loans are almost 37%. The ratio is still at around 37%. So need to be tackled. As Mr. Evans said, this is something that is crucial to support the supply of credit. What could be done in this respect? First of all, it is crucial that there is an efficient judiciary. The judicial processes are efficient, and they are done effectively in a timely way. This is particularly important in light of the introduction of the insolvency legislation, which was mentioned by a few speakers. The legislation is being finalized and will be implemented as of January. It is crucial that there is sufficient judicial capacity to implement it efficiently. This is a matter of training, of course, of judges, to have the sufficient staff to implement the law in the right way. I just like to remember that this law is substituting a number of legislative devices, including the Katseli law, not directly, but in practice it will replace the Katseli process. The Katseli law, of course, it had flaws, but beside the flaw, it was the implementation which was particularly detrimental to the development of non-performing loans and the overloading of course. Related to this, of course, it's important that the payment culture is restored. The new insolvency law, it's an opportunity, provided it is finalized in the right way and implemented correctly. As the minister said, in the coming weeks, there will be fine-tuning and then hopefully the finalization of the law after the comments, after the consultation will be taken on board. Especially as the situation stabilizes, it's important that all processes, the insolvency or e-auction, are made efficient and will play their role in disciplining in restoring the payment culture. Let me just, I'm almost done. Let me just return to what I said at the beginning. We have seen a strong recovery in loans to enterprise, but loans to household not. And beside the COVID-specific factor dampening the demand, there is also the problem that the banks have. For banks, it's not easy to extend a loan to household for house purchases because the mortgages, the collateral linked to mortgage is difficult to be efficiently managed. And unless there is a change in the way in the legislative and various framework conducted, this could be an impediment for the expansion of credit in the going forward. Last point is that beside this, it's clear that the government will need to play an important role also in the long term. We have seen that the Hercules facility is playing an important role in reducing non-performing loan. Whether it would be sufficient or not is a matter that the government could decide later, whether there is a need of fine-tuning. Of course, we all hope that the expansion, as Mr. Milana said, of MP will be modest, so the fine-tuning will also be modest. There could be other tools that the government is discussing with Bank of Greece, the HFSF. I'm very pleased to see that there is a nice collaboration between all institutions, and let us see what in the autumn the discussion will be. So thanks, I stop here, and sorry if I was a bit longer.
Thank you, Mr. Drudi. The floor goes to to Professor George Pagoulatos, the General Director of ELIAMEP. We have 10 minutes, and I would like to ask you a question as well. So the floor is yours.
Thank you very much. I'll take a step back, and I'm going to make 4 points on the Eurozone macros. And the reason I'm doing that is because even the most efficient firms, even the best-intentioned governments cannot escape the macros. Point number one, the COVID crisis found the Eurozone in a state of vulnerability and fragmentation. And in a state of vulnerability, the parts of the Eurozone that were exiting a prolonged period of fiscal austerity and adjustment programs, which left behind firms struggling with higher taxes, higher capital costs, declining investment, lower employment rates. All these factors suppressed economic growth potential in the southern periphery of the Eurozone. To these were added fragile banking systems, high legacy NPLs, high levels of public debt amounting to limited fiscal space. Point number two, the policy mix that was followed by the European Union, by the Eurozone in the face of this crisis, the COVID crisis, was far more successful than the previous one under the Eurozone debt crisis. And it did a lot in order to address the fragmentation, the vulnerabilities that I mentioned. In the Eurozone debt crisis, the ECB had carried the main burden of providing the backstop, especially after 2012 and 2015. And there was very limited fiscal response, mainly provided at national level. And in those cases, it was mainly pro-cyclical rather than counter-cyclical. Now, this time around, in the COVID crisis, the ECB reaction was massive, ahead of the curve, meeting the high expectations of market participants, but there was also sufficiently counter-cyclical fiscal response, mainly at the national level, but not limited to the national level. The response provided at the Eurozone level, at an EU level, was significant and was macroeconomically substantial, and it was clearly counter-cyclical. The Next Generation EU program, 750 billion, 390 billion of which is grants, provides a strongly counter-cyclical support to the countries of the Eurozone. I remind you that 70% of the grants under the Recovery and Resilience Facility shall be committed for the years between 21 and 22. All this operates as a sort of insurance scheme, targeting funds to the countries that are hardest hit by the crisis, which is something that is severely needed by the Eurozone. And it's very important also that the composition of grants is significant compared to loans, that the joint issue of debt by the European Union is very substantial, backed by own resources, in the expectation of tax revenues through green taxes and FTT and tech companies down the road. The big question in all of that is how much of this will become a permanent feature of the Eurozone. If it does, and of the European Union, if it does, it will provide the resolution for future crises as well. Point number 3, the legacies will be persisting after the crisis. The Eurozone economies and the European Union will be exiting the crisis with a significant debt overhang, even though this debt is mainly good debt, in the sense that was also mentioned, in the sense that it will be directed to investment, to green development, to digitization, to upskilling and reskilling. The levels of debt, the stock of debt will be very significant. Now, we know in theory that there are 5 ways through which any economy can deal with a high debt overhang, and all 5 of these in different degrees and combinations will have to be utilized. The first is, of course, the best way to deal with a debt crisis is high growth. And high growth is a beautiful thing, economic growth, except that you cannot command it. Clearly, the fact that much of this debt is directed to productive investment will help raise the future growth rates, especially if it is, as it is, compounded by significant structural reforms on the ground, such as those that were mentioned by the Minister. The second is through fiscal consolidation, fiscal austerity, and clearly there will be a significant reliance on fiscal consolidation on the medium term after the recession is over, but there are limits to that, especially if it undercuts the productive capacity and investment in any economy. The third is inflation and monetization, and this is probably not going to reach that point, but the monetary policy stance will inevitably remain accommodative, expansionary for many years. This has implications for banks. Zero bound interest rates will affect the profitability of banks. They tend to create distortions, but this is the inevitable and the necessary to move forward given this crisis, especially given that deflationary pressures in the international environment will probably counter and overwhelm the inflationary pressures that will be produced unless the global supply chains completely break up, which is not the highest probability that we are facing. The fourth way one can deal with the debt crisis and debt overhang is by default or debt repudiation, and I think that we will be witnessing restructuring of private sector debt in various ways, but there is a space for the central bank to perhaps roll over sovereign debt in the future towards perpetuity. This is something that has been exercised by other central bank institutions, and perhaps it would be advisable given the circumstances of very high debt overhang. And finally, what we have seen in the past in history are instances of financial repression. There have been decades since the European Union economies got rid of financial repression, but we might be witnessing instances of financial repression in various ways returning. Point number 4, and I'll conclude with this, we must not forget the reform agenda of the economic and monetary union. After the crisis, we'll be left with the structural, the construction deficiencies of the economic and monetary union. We will still be in need of the reforms that have been suggested by a number of European Union institutions, including the European Central Bank, including the Commission, reforms towards deepening our monetary union, reforms towards particularly two directions. First, improving risk sharing in the Eurozone. Second, strengthening the counter-cyclicality of the Eurozone, its ability to address crisis in a more effective way, its ability to address asymmetric shocks in a way that provides the stimulus that is needed when it is needed in order to be able to rescue economies from suffering the devastating hysteresis effects of prolonged austerity programs that could have been avoided, could have been prevented. Thank you.
Thank you, Professor. Just one question for, please, 1 minute answer. And I would like to pass the floor to Mr. Skylakakis, the alternate Minister of Finance. Recently, the Prime Minister announced a package of measures. Are you intending to finance these measures via the RRF? Will you apply for funding from the Recovery and Resilience Fund facility?
No, not from the RRF, as I can see the specific measures are within our budget. And you have to remember that they refer to 2020 and 2021. Maybe there are some that can go to the other instrument, REACT-EU, but we will discuss that with the institutions. In general, the RRF is a vehicle for reform and investment. And this is what we must do. The measures that we have are not permanent, but the measures that we expect to have after 2022 will be permanent, and for that we will need to move a lot faster in terms of GDP and in terms of reforms to create the fiscal space to have permanent tax and pension contribution reductions.
Thank you very much. Quick question to Mr. Costello. Are tax cuts or tax incentives eligible for funding? And to Mr. Saarenheimo, we are under a flexible fiscal policy framework. When do you think that the Eurogroup will discuss its finalization? Mr. Costello? We can't hear you. Are you unmuted? I don't think that was a difficult question, so if possible, Mr. Saarenheimo is on our line?
Yes, I am.
So,
can you hear me?
Yes, we can hear you.
Very good. So the question was about the fiscal framework and the suspension or the activation of the so-called general escape clause. Now, this is a political discussion that is yet to begin. There's, as of today, a very wide agreement that it would be unwise to launch that discussion at this point. There's a very, very wide consensus that given the epidemic situation, next year will still be a year of very strong fiscal expansion and beginning the debate on resumption of or re-establishing the fiscal framework would not be productive for that. And that said, many countries do actually rely on the fiscal framework for their domestic budgetary discussions. They appreciate the guidance it provides, and there have been calls for some restoration of guidance from the EU. I don't know when the time will come from that, but I would suspect, my guess would be that towards the next half of next year, provided the COVID situation is tackled as expected, that might be the time when we start re-establishing the framework, but it needs to be done in a very sort of thoughtful manner, not introducing any cliff edges. Thanks.
Thank you very much, Mr. Saarenheimo, Mr. Costello, Mr. Pagoulatos, Mr. Skylakakis, and Mr. Drudi. Thank you, you all for watching the discussion. We can move forward.
Thank you.